Wait, what? How the heck did I fail this challenge? I was in profit, doing well. And then suddenly I get an email saying that I have violated the daily drawdown. How many of you have been in this exact situation when it comes to prop firms? I definitely have, and it is not fun. The truth is, prop firms have very sneaky ways of catching us out to try and get us to fail their prop firm challenges. But why do they have to be so sneaky? Well, it's because most prop firms make money when we lose money. This means that they are directly working against us to try and ensure we fail so they make profit. And this is not a very mutually beneficial relationship, but unfortunately, this is the reality. So what can we do? Well, we can try and choose the prop firms that have more fair rules and stay away from the ones with massive red flags. In this video, I'm going to be doing exactly that. I'll be going over the major red flags that you need to be looking out for when choosing your next prop firm. And make sure you stick around right till the end, because I'll be showing you how you can actually take advantage of these prop firms to make maximum profit. Right, let's start with the first major red flag, and that is prop firms marketing. What do I mean by this? Well, if a prop firm is clearly over pushing their challenges and their fees on all their social media and online more than what you would normally expect to see, then be very careful. Now, obviously it is normal for prop firms to be marketing because at the end of the day, it is a business, but you would normally see the marketing happening alongside most of other businesses. For example, your Good Friday, your Cyber Mondays, your major holidays, all these kind of places where all companies are normally putting their deals out. That's fine. But it's when you start to see the prop firms putting out way more than normal, constantly having deals, constantly shouting out coupon codes, and also using social influencers to push their product. That's when you've got to be very careful, because obviously they want you to buy as many of their challenges as possible because that's how they make money. But then once you have bought into them, you'll probably find that these prop firms make it very difficult, either through their rules or when they actually come to giving you your payouts. They will probably find any excuse not to pay you. This leads me directly to the next red flag, and that is when prop firms appear to be too easy. Like, for example, they say you only need 6% to pass phase 1, 3% to pass phase 2. There's no minimum trading days, and you can take withdrawals once a week, or in some cases even every day, daily payouts, which is kind of ridiculous because these are the prop firms that are making it appear to be super simple. But one of two things happen with these prop firms. Number one, they are actually simple, and all that happens then is more people are actually passing the prop firms and more people are actually getting to payouts. Now, what happens is that means more people are ultimately digging into the fund that they are building up from people buying into the challenges. So they're slowly getting less and less to actually give the payouts with. And this is what happens with some companies, that they end up going bankrupt because they no longer have the money to keep paying the people that are actually requesting the payout, or they are constantly looking for excuses to not pay you out because they no longer have the funds. The other option is that they make it appear on the surface to be very easy, but then there are hidden rules or rules that are maybe in their website but a little bit harder to find, where they are constantly catching people out and people are failing because of these rules. So they make it appear easy, but then there's certain rules within those that are actually making it harder in the long run. So be very careful when you see a prop firm constantly making their challenge appear easier. The next one I want to talk about is one of the trading conditions in particular, and that is the drawdown type. So you get three different types of drawdowns. Number one being balance-based drawdown, number two, equity-based drawdown, and number three, trailing-based drawdown. Now, the one you want to go for is the balance-based drawdown. Why is that? Well, let me talk about the other two first and we'll come back to this one. Equity-based drawdown can be okay, but it actually can catch good traders out, which is crazy, thinking that the better traders are the ones that probably will be the ones that get caught out in this. Let me explain why. I'll jump to the chart quickly and show you an example. So I'm on gold here. Let's just say I've just taken this trade today starting with a brand new 100K challenge, and I'm looking for a 1 to 9, 1 to 8.5, let's say, for example. So a fairly high risk reward trade. Now, the problem with this is, as you can see here, this pushes up all the way to, let's have a look. So, okay, so let's say we're actually targeting the top here for a 1 to 10, okay? We're looking for a 1 to 10, and now it hasn't hit our profit, and we haven't taken any partials yet. We are looking for either a loss where we lose 1% or we make 10%. So it's potentially a one trade past the challenge kind of trade. So let's have a look at this, and I'll explain why the equity one is so bad for traders that trade this way, which are normally the good traders. So let's say you enter here, you push up. Now you have pushed up all the way to about, let's have a look, about 9R, right? 9%. You've gone all the way up to 9%. Now what happens is you are based on equity, right? So now what'll happen is if you were to come all the way back down and let's say lose this trade where you're essentially only losing 1%, based on equity, you would have come from 9.5 all the way down to an extra one, at least 1 and a bit percent. So you would have basically failed the challenge because based on your equity, you lost over 10% in this move over here, but you haven't actually lost that much in terms of your balance. At the end of the day, with your stop loss in place, this trade doesn't go your way, it pushes all the way down and eventually stops you out. You will actually fail this challenge because based on equity, you've actually now lost even more than the 5%. So you could potentially even lose it over here because remember, you've only got a 5% a day equity based drawdown. So look over here, guys, you actually come over here to let's call it 4.5%. You drop back down. Now you are very close to that 5%. So maybe you would have just got away with this one. But let's say this move even went down a little bit further, it doesn't stop you out. You probably even then would fail the challenge because you, based on your equity gets to 5%. Then it drops down, has a retracement to back to entry and a little dip below your entry. You're still not out of the trade, but you fail the challenge because you have essentially lost 5% based on equity. And this is why this form of equity of drawdown can be a very tricky one. If you are taking a challenge that is based on equity, you would have to completely change how you trade. You would have to only basically trade for like a 1 to 2, 1 to 3 max RRs. So you've got to be very careful because you've got to take into account that even if you go into profit and you come back down, even though you don't actually lose the trade, you could still lose the challenge. So that's why I don't like the equity. I do trade some prop firms that have equity, but I trade with an EA, I trade with Titan X, and that has always got an equity protector of, I think it's like 2 to 3%. The profit target is never more than 4 or 5. So it's normally okay. The next one is trailing based drawdown, which is actually just complete bull rubbish. So let's say, for example, you go into 5% profit on a 100K account. Your balance is now 105,000. You close, and that's your next balance. The next day you're going to trade on. So now your overall drawdown is no longer set at the 90K mark. So when you start your challenge, you can go up to 90K. Anything below that and you've lost your 10%, you've gone over 10% maximum drawdown, right? Where it trails, essentially as you're making profit, you're actually getting punished for profiting, which sucks if you think about it. So as you profit, the drawdown line is moving up with you, right? So this is a problem because you could get to 7,000 or 8,000 and now your drawdown line is actually like 1,000 or 2,000 below your starting point. So all of a sudden you don't have that freedom to go below the 100K anymore. So for that reason, I don't like the equity based one and I don't like the trailing drawdown. Because let's say you actually get to a funded account with this and you basically get to like 11,000 profit. Let's just say, and most people would take their profit before that, but let's just say for argument's sake, you get to 11,000 and then you lose, you go all the way back down to like the 100K or the 100 100K, $500, you've now essentially lost 10%, but you are still above your starting point, but you will lose the account. The account will be taken from you. So my opinion is, if you are looking for prop firms to trade, I would always look for the ones that are balance-based drawdown. I think they are the best. You've just got to change the style you trade. So if you are looking for big risk-reward ratios, you would have to just change that and just change the way you trade. Oh, and by the way, before I share the final red flag with you, if you'd like to pass prop firm challenges and get funded 100K or more in capital without ever having to take a single manual trade, then make sure you go over to www.propfarming.com and watch the demo for more information. Over the past 4 years, we have dumped over $2 million in developing what we believe is the best AI trading system for passing prop firm challenges. And we've now helped over 800 traders get funded 100,000 or more. In fact, we're so confident that if we don't get you funded, you will not pay a penny. So make sure you go over to www.propfarming.com. You won't regret it. Right, now the final red flag I'd like to talk to you guys about is kind of like a combination of a few things. Number one is how long the company has been running. Is it a fairly new company? Not that that is a bad thing on its own, but it's something you just need to look out. Do the owners of the company or the CEOs or the people running the company, are they fairly young and inexperienced? And do you find the owners or the CEOs or the people running it showboating on social media? These three in combination is a big red flag, because if they are suddenly showboating their lifestyle, the cars they drive, the clubs they're going to, that means they are potentially doing this with the money you are giving them by taking challenges. This is one that you've just got to be very careful. Make sure you do your homework before you sign up for a prop firm. Just get an idea of how long they've been around, who's running the company, where is it based. You know, just be careful of the social media type prop firms where these guys are boasting about their lifestyle and the money they've suddenly come into, because there's a good chance that money is what they should be paying their funded traders with, and instead they're living the lifestyle. So just be very careful with that. We have seen a few, I'm not going to mention names, one that recently closed down, started up. I'm not sure if they're back. Like I said, not going to mention names, but the owner was quite prevalent on social media, throwing a lot of money around, seen in clubs, doing silly things with a lot of money. So just be very careful. That's the final one I want to talk to you guys about. So be sure that you are looking out for all of these red flags. And the final thing I want to talk to you guys about is how to actually trade these prop firms, guys. Prop firms are kind of a business model where unfortunately they make money when you lose money. I've talked about this in one of my previous videos. I'll leave that video at the end of this video, where I basically talk about how you can trade prop firms from now on. And the way I think you should trade prop firms is essentially trade them like they are going to close. Not that they all are, but I think if you trade prop firms like they're going to close, you essentially flip the switch on them and you take advantage of them rather than them taking advantage of you. How do you do this? Basically spread your eggs in multiple baskets. Take a few different challenges on a few different accounts. Try and spread the number of challenges you take over maybe 3, 4, 5 different companies. And that way you can basically run them all. And if one gives you a hard time or closes, you can then basically fall back on your other 3 or 4, and then you just start with a new one. I've spoken about this in more detail in the video, and I'll leave that at the end. So that's the way I've kind of started trading these prop firms. I now trade them like they are going to close. And essentially all I'm thinking is make as much money as I can before they do. Because if you have that mentality, that mindset, you're not going to be disappointed when they do close. So that's it from me, guys. I hope you enjoyed the video. I hope you found some value, and I hope it helps you pick your next prop firm. And with that being said, if you did like the video, if you have not subscribed to our channel yet, make sure you do subscribe, because we're going to be doing a lot more videos on prop firms in particular. We want to cover prop firms. We're going to be doing a lot more reviews, so you don't want to miss that. So make sure you subscribe and get all the juicy information. With that being said, guys, that's it from me. I will see you guys in the next video. Bye for now.